Welcome. Today we're going to go over how we're positioned in the portfolios. We're going to get into that CPI information that came out early this morning, and we're going to talk about how we're positioned going forward. I'm Aaron Tuttle, Chief Investment Officer at Gatewood Wealth Solutions. I'm joined by Chris Ahrens, Portfolio Analyst here at GWS. And let me just jump right into it. Let's just go back since the last recession that we've had. Not that long ago. Let's look at it a different way.
Yeah, this is just the index level, so you're going to see the market moving back and forth, like you said, some of that pull forward in return. So this looks back, and this is a chart from Dr. Meldrum, a CFA professor that teaches the curriculum, and it looks back over 5 years and says, all right, what do average returns from 5 years ago look like? Well, stock market averages have been between 9 and 11%, somewhere around 10. So that's that middle white line going up across, and 9 is the low and 11 is the high. And you can see that the stock market does return higher and below, and it goes higher and below, but it's going to mean revert over time. And we saw this big pull forward, and now it's coming back down towards that mean level, which would put us at 38.30, 38.50 on a 10% annualized return for the last 5 years. And we're right around 4,000. So we're pretty close to mean reverting to that 10%.
And when you mean revert, oftentimes you go a little bit lower, though.
Right.
So that's there. And
so the undershoot would be, so what are you looking at to try to find a bottom? Well, like you see here, it does revert below. And so we will likely, if we are going to start heading into recession, see the mean reversion below. And if that happens, you start getting below that 9% return in the 3,600 range, that's when you're starting to say, well, maybe there's a fundamental reason to start buying. Because down there, we're back to historical price to earnings ratios. We're back below around 16 on the PE, when that's a 25-year average is 16.8, I believe. So coming out low, you're going to see fundamental reasons. So would I like to buy down there if that earnings are still holding up?
Yeah.
So we're looking at 12 months out earnings expectations on the index at about 243 per share. That would look attractive. So if we see that mean reversion and pulling down below and earnings still holding up, that's when I think it's going to be tilt away from what your equity plan would be and add more equities.
One of the things that we talked about last week is we haven't really seen an earnings recession. Now the problem is that could be out here in the near future. All we've seen is reduced guidance, but really the higher interest rate, which is causing that PE multiple to do a contraction.
Mm-hmm.
So I think this is a healthy pullback and not an unsurprising pullback. It's difficult to time, but you know that there is going to be a mean reversion there. You just don't know when it'll happen on that. So this has been healthy, and if we do get lower there, the good thing, as painful as it is to watch the market sell off that much, is you can now be constructive on the market because it's at a good value.
So that's some fundamental and actual data. If you want to get into anecdotally, I know we saw yesterday on CNBC, Leon Cooperman, family office billionaire, he was saying, well, what he's looking for to try to find a bottom is he wants to see bad news, really bad economic news, brings stocks lower, but they close up by the end of the day. Because to him, he's saying, well, now stock market is actually pricing in all that bad news already by showing a little bit of a rebound.
Right, and people are finding that to be now at a value at a discount, and then they're entering into that market. That is a good anecdotal indicator. And then for Dr. Meldrum on his stuff, a lot of people say we're too technical. Some people say we're not. If you really are in that latter camp and you say you're not technical enough, Dr. Meldrum's YouTube channel is definitely on the more technical side. It's great information. I think it's a paid site, though, is it?
No, he has both.
He has both?
Just started a free one.
So it's definitely a good blog and one that we pay a lot of attention to.
So we had the big rebound after the Fed meeting on Wednesday, and it was quickly taken back off on Thursday. And so the question really is why? What drove that down? And it was probably this economic productivity number that was released. So this is just productivity, production based on the amount of work. So producing more with less would be great, or producing more with the same amount would be good. We produced a lot less with more. So that was a 7.5% decline in productivity. Got to go back to the 40s to see a decline like this. This was a really bad productivity number. And our hourly wages were up with productivity down, so that's unit labor costs are up to 11.6% gain. Significant gain on costs. This is just saying stagflation is here.
Right, and I would say that that's probably accurate if the Fed can't kill inflation, but we'll talking about that. Speaking of inflation, the numbers came out this morning. What was your take on that?
What I was looking for is that core line, so that's getting rid of the food and energy, because this is what the Fed looks at. They admit they can't control food and energy prices, and they're going to be volatile. And so expectations for core inflation were to continue the downward trend. It had been down to 0.3, so about 3.5 annualized on the month, and that's really what we wanted to see. That's what the Fed wanted to see. They admitted it. They said it's not a trend, but we do want to see it coming down. And this was a bad number. It came in at 0.6.
Right.
So significantly higher on the core. And so what the market was really saying is we want to see a data point that tells the Fed to slow down, that they don't need to continue pulling away accommodations. This isn't that.
Right.
This was not a good number.
If you look at all items, though, at the top, you can see you could make the case that maybe we're slowing, but to your point, and the market has certainly sold off since the numbers has. Now it's rebound back to your anecdotal evidence, but we're definitely going to continue to watch here. We were expecting to see numbers below this on that core. We didn't get that. The question in the back of our mind is, do we need to go to the bill rate? Do we need to do cash? And we'll get into that in a little bit on kind of how we're thinking about it. So then, do we go to more cash? Well, this is the big indicator that we're looking at, which is money supply, which is that green line. I've probably talked about it 3 or 4 times the last couple of weeks, so maybe people are getting more familiar with it. I'm very concerned about the trend line for money supply, because in less than 2 weeks on this trend line, we're going to be below 2% on money growth, and within 4 weeks, or just coming into that June 1st time frame, when the Fed begins to actually roll money off of their balance sheet, which will pull it out of the economy, would contract money supply. If that stays as is and that trend line holds, that's what we're looking for to go to the bill rate, because that could cause a liquidity crisis in the market, similar to a 2008. I'm not trying to scare people. They will act much faster than 2008, so that's one of the big hesitations of not being in the market.
What do you mean by act?
The reverse course. And go back to 2018, whenever they started to roll money off, they quickly reversed course, and we went from a bear market to quickly rebounding.
They're raising rates, and then they cut them right away, right?
So I like the people talk about dove and hawkish. I just like to call them chicken hawkish. They want to be out there, rightfully so, trying to kill inflation, raising interest rates. It's actually what they need to do. But the moment the market really starts to show signs that there's a recession here and they need to be accommodative, they're going to be accommodative. And here's another indicator, and it's similar to that relative strength where we're looking at the T-bill rate, but it's an easier way to do it. Is basically you line up every fund out there and you say, let's rank money markets. Usually it should be the worst performing at the bottom. Everything else should outperform it, unless it's not. And a lot of times it just runs up. It starts to get high, 60, 70%, and then the market rebounds. It's a buy the dip mentality, which would be the correct behavior. We don't know if it's 2008. It's way too early to tell to see what the Fed's going to do, but that's what we're watching is how this money supply, what's the Fed going to do, and what's the interest rate. A lot of people are saying, Aaron, why don't you just set this out and let's not forget it, and let's forget about it and wait for the market to come back. Well, more times than not, the market quickly rebounds. It'll be up within a week 5 to 10% easily if things are starting to get the all clear. And if we look back and look at the technical indicators and going all the way back to 1990, there's only one time period where a year from now we're not doing substantially better. Many of them are 20, 30% rates of return. There's only 2 time periods that are negative, which are really the same time period as the 2008 correction. So more likely than not, this is a good time to add money to the market. We're just watching that trend line on the Fed to see, are they going to push us into recession by continuing to raise rates, or are they going to slow down and start talking some of that back out of the market? That's the big takeaway. Another thing to look at, and just throwing things out there, I know for you guys, I'm sorry, but we are looking at a lot of things, is we talked about the anecdote of bad news comes out, market sells off, rebounds by the end of the day. Certainly a good sign. One of the ones that I get concerned about is when you have 3% moves down, especially like we did last Thursday, 3% up, next day's 3% down. It's a sign of a sick market. So we're looking for 3% down days consistently. It only happens a couple of times. 1987 it's a famous stock market crash. 2008, everyone is aware of, and then we just had the recent one in 2020. So it's too early to tell on whether we need to go to the bill rate. There's certainly risk here. If we were just to go to miss the upside, we want to see if the Fed is serious about this inflation fighting and they're going to raise rates into what would be a recession. So
I was just going to say, when you have those really volatile days, those 3% days, there's not a lot of real pricing going on. It's people are just saying, "Get me out."
Yes,
you know.
Yeah, that's but that's just showing the sentiment. People are ready to get out, and it's like you said, whenever you start to see those bad news days and people move back in, you know the sentiment is changing, and you'll start to get rational pricing back into the market. Basically, dollars become really, really scarce, and everything is denominated in dollars, so everything else will trade against that, so there would be no other place to hide. But we would still be taking the edge off in our positions. They would hold up better. So then that gives us opportunity whenever we finally get through this, and we will get through this, that we can then position back into a growth portfolio to capture the upswing. So we can set out our sails again. We got our anchor and we got our lifeboats out, but we want those sails to finally catch some wind, to use that analogy. I guess Chris doesn't like my analogy. I really appreciate you guys tuning in. If you haven't subscribed yet, hit that subscribe button. If you didn't hit the like button, hit the like button if you like that Chris is not in athleisure this week. He's back in a suit. And obviously share this with any of your friends. If you want to contact a lead advisor or talk to any of us, please reach out to the number on the screen or come to our website and request a meeting with us. We appreciate it and see you next week. Thank you for watching. Be sure to like the video and press the subscribe button right here so you never miss an update. If you have any questions or would like to get in touch with an advisor, click the link in the description below to request a meeting. We'll see you next time.